Hello, everyone. My name is Pete Sweeney. I'm the Asia editor of Reuters Breakingviews. I'm here today to welcome you to a conversation between myself and Charles Lee, the chief executive of the Hong Kong Stock Exchange. Thanks so much for coming and talking to us, Charles.
Thank you. It's a great pleasure.
Well, look, I'll start off with the big question that's on everybody's minds here in Hong Kong. As you know better than anybody, there's been this current debate over who gets to control, who gets to list on your exchange, and who does not. Now, some have suggested that because the Hong Kong Exchanges and Clearing, is a commercial company that makes money off of listings, that therefore there's an inherent conflict of interest, and they point to governance problems, misconduct, and they say that this is the root of the problem. Do you believe at this point, given the reputational risk, that it is time or a good idea to hand over more authority to the Securities and Futures Commission?
Yeah, I think it's really a misunderstanding of the setup here. Hong Kong Exchange is not just another commercial entity running an exchange. It is in many, many ways a statutorily set regulated exchange. And that exchange, if you look at our charter, public interest is actually number one. Shareholder interest is number two explicitly. And the government appoint half of I have 12 non-executive directors. I'm the only executive director. Government appointed 6 one of them. And also it's essentially anti-takeover. So the public interest is all around, the Hong Kong Stock Exchange. And we are regulated, by the SFC as a listed exchange. So in many ways, we are serving that frontline regulator, role, and the public interest overwhelms whatever commercial interests that people think that might be in conflict.
Okay, so with that in mind, Ashley Alder at SFC has said that there's this process over how the authority would think. It seems like that was inconclusive, and that therefore they are, pushing forward this front-loaded regulation where they're going to be more proactive in terms of going after IPOs that they think are ill-conceived or for whatever reason, and suppressing those. What's your take on that initiative by the regulator?
Well, the SFC has always had that authority under the SFO, and historically it has been conducted in a particular manner. I think they have every right to conduct it differently. Whether it's front-loaded or back-loaded is really just a metaphor. But essentially, the listing rules is executed, administrated still by the exchange. And then the broader public interest mandate in the SFO, now the SFC would like to take a slightly different approach. But the key is the market will understand that the bulk of the listing rule regulation is still going to be at the exchange, but the SFC will take that proactive role whenever they see fit.
Okay, so one of the on the other side of the equation are the people who complain that the Hong Kong exchange is not innovative enough. I mean, you guys are the biggest IPO market in the world, I think, last year, but people point to relatively low representation by tech companies. I think Jack Ma of Alibaba and some others have come out and said that you guys really need to innovate. And one of the specific things they're pointing to is these weighted voting rights.
Correct.
These functions by which a key executive can maintain control of a company without actually owning the majority of its shares. Now, not all tech companies have these structures, and the IPO market seems to be going okay. Is this an urgent problem that needs to be solved? Is this really a critical innovation for tech companies to come to Hong Kong?
Well, we are not really, we take a neutral position in terms of the philosophical differences between, shareholder democracy vis-a-vis innovation, vis-a-vis the special need of those companies wanting to exercise greater control over a longer period of time, despite of the owning shares. This is the very big philosophical debate that we're not taking a position as an exchange. However, we are taking a position that this is a very important issue for Hong Kong. And in order for us to stay competitive and stay relevant, we need to find ways to attract new economy companies, particularly big winners that have that particular structure. U.S. market is always thought to be the best, deepest, and the largest capital market. And that's where they allow this sorts of offerings. And there's no reason why we need to opt ourselves out of that system. But broadly speaking, we're really providing the market with a choice. We're not saying it's good or bad. We're not saying you have to do it or you're encouraged to do it. We're simply saying that if you have a strong reason to list here, many of the big Chinese companies have a very strong reason to list here, then we give you a choice.
So is there a middle road you can take? I mean, what would the exchange itself do, apart from these weighted voting shares, to address both the misconduct issues that I don't think anybody disagrees are a problem, and also stimulate innovation without diminishing shareholder democracy, which seems to feed into these other issues. I mean, apart from those things, what can the exchange be more proactive about going forward?
Well, I don't think it's fair to put these two together. There are a lot of misconduct. Every market has misconduct. Every market have bad apples. But weighted voting right had nothing to do with that. So let's not put them together there. In terms of actually fixing, the problems that existed, every market, the great U.S. market have Madoff, right? The great U.S. market have WorldCom. So we all have our own bad apples. We're going to fix them. But a lot of the bad apples are fixed when the problems surface. Sometimes people think that we can fix all the problem by issuing licenses. So when you issue licenses, and which is the listing decision, the vetting decision, people pass driver test. But it doesn't mean that later on it doesn't become a problem on the road and is going to drink and drive. So when we find that problem, we fix it. But
isn't that just reactive, though? I mean,
no, it's not reactive. It is. Every market is reactive. Every criminal prevention is reactive, because people need to understand the listing regulator's role is to vet before you're coming in, and continue to monitor and regulate your behavior afterwards. The life after listing is much, much longer than the life pre-listing. So you cannot have the cops to determine who might be a criminal offender when at the time of passing the driver's test. So when you pass the driver's test, we still have to continue to watch you whether or not you will behave on the road. And that's really, most of the challenges are not at the vetting. And if you somehow think a regulator can prevent bad actors from ever entering into the market, that's an illusion.
Sure. Okay, well, let's talk a little bit about another structural aspect to the market. So in addition to being relatively light on tech shares, others have pointed out there's a less and less ratio of non-Chinese foreign companies listed here. They've also noticed that like some of these companies, like Glencore, Prada, IPO'd here, the performance wasn't very good. I know that you're interested in attracting Aramco here, which would be a monster IPO.
Yes.
So like for Aramco and for these other firms, are there any specific policy changes or environmental changes you might be planning to make this more attractive to non-Chinese foreign firms to list in Hong Kong?
Yeah, I think if you already have free access to international capital, and the proposition of listing separately in Hong Kong on a secondary basis is probably not that compelling, because the investors here are free and open. They can choose to invest anywhere. So the key here is that through the establishment of Shenzhen and Shanghai Connect and Bond Connect, we are now building a very unique bridge between the domestic capital pool and the international capital. So right now that connect is on a secondary basis only, meaning that a company have to be listed here in order for the southbound investors from China to buy. If one day we are able to extend that into a primary offering, meaning a foreign issuer can directly sell through Connect into Chinese investors, major institutions, or public investors at some point into the future, that will open the door for a massive new breakthrough for the international capital.
No question about that. Do you think mainland regulators would be, or have they told you that they're open to the idea of letting that much money flow out? Because I know like the IPO market in the mainland has been subject to massive speculation and capital flows at one point distorting money rates. Have you received signals from Beijing that they would view this sort of thing positively?
Well, I think you need to look at China in a very dynamic manner. One day it won't want to open, another day it want to close down a little bit, but the broader trend is has to open. And also the Connect system provide China with the way of accessing international underlying, but without necessarily seeing the money leaving China, because the Connect program is exactly by using domestic infrastructure, domestic regulatory structure, domestic clearinghouses and exchanges to essentially not opening account necessarily outside in China, but relying on those account systems inside China, but investing in something.
So the primary would be like a synthetic.
Exactly. No, it's not synthetic. It's
well,
direct.
It's not actually crossing the border.
No, it does, but the shares is actually custodied in China clear,
Okay.
rather than, typically you have to move money out first and open accounts in Hong Kong. This one, you basically rely on the Chinese infrastructure, but the money actually does go to the issuer, and then the trading will be happening in Hong Kong. But when you sell that share, the money flows back to your account. So that's essentially is not a capital flight vehicle, it is a total investment vehicle. And at some point, it's the Chinese regulator will determine if one of their mission is to help the Chinese to deploy their capital on a global basis, which has to happen at some point, then this will be one of the best systems for them to achieve both the goal of investing, deploying capital outside China, but also protecting that capital flow if they think that's continued to be very important.
Okay. Well, thank you so much. That's all the time we have. Thanks for coming on board. And thanks for watching. That was great. Thanks, Charles.
Thank you.